Hello there everyone. In today's video we're going to take a look at a bit of succession planning in an SME business. So let's assume we've got mum and dad and two kids as four shareholders in a limited company. And mum and dad have got a decent pension pot in place. You don't have to worry about topping up their pensions. But the kids, the next generation, haven't really done much with pensions so far. So we'll be keen to put as much into their pension as we can. And also, the kids have got some plans for the future direction of the business, and they've earmarked a commercial property which they would like to buy to bring into the business to help the future expansion. So, how do we do this from a tax efficient point of view? Well, let's take a look. So, four directors and shareholders. Like I said, two generations, mum and dad, two kids. Now let's just assume there's 500,000 sat in the company bank account, and pre-tax profits for the year, let's say they are 250,000. Now the point is that the next generation, the kids, the adult kids, haven't done much pension provision in the past. They have done some auto enrollment for the last few years, but they haven't done any big chunks into a pension. So because of the generous annual allowance capabilities that are available, let's just assume that they all of a sudden decided to do 100,000 each into a pension from the limited company, because the annual allowance, you've got the carry forward capability, so they can do 100,000 each, and the cash permits it, assuming that that's not gonna, they don't need all of the cash for working capital, they've got a bit of spare cash, so move 200 grand into a pension. So the 200 grand goes into a pension. Now, what does that do from a corporation tax standpoint? Well, assuming the 25% corporation tax paying entity, that's going to save 50 grand of tax. 50. 200 grand goes into a pension, comes off the bottom line. Instead of having $250,000 taxable profits, they're left with 50,000 taxable profits. So they've saved 25% of 200,000, 50,000 pounds corporation tax saved. Right. So the next thing is they've got this pension arrangement. Now, specifically, we're going to look at this family SIP arrangement, which basically says the purpose of this pension is to acquire a commercial building. So technically there are two halves or two subpots for this family pension. One for one of the individuals and one for the other. So there's two. Remember, it's the next generation. So there's two of them. So basically, to all intents and purposes, it's one combined pot. But strictly speaking, it's two mini pots, and they've got 100 grand each. So there's 200 grand. Now then, let's just assume that the commercial building that they've got their eye on is worth 300,000. So 200 grand has come in from the company, but they've seen the building, they want it 300,000. Well, the pension can borrow, go to a bank like a limited company or a sole trader. A pension in its own right can borrow money, and the rules are it can borrow up to 50% of its value. So we've set this pension up with 200 grand cash. That means what's 50% of that is 100. So 200 grand cash. The pension can also borrow 100,000 from a bank. Then all of a sudden you've got 300 grand of cash, and you go off and you buy this commercial building. Now it may be that they don't need to get a loan, depending on the circumstances, because if they had more capability to do more than 200, let's say they could have done 150 each and done 300 of cash, they could have bought the building outright in one go in the pension without the need for leveraging up via the bank. But you have that capability with these pension funds. So when they actually buy this commercial building, let's also assume that there are tenants in there. So yes, they're going to be using, it's a big shed, big commercial unit, but there are some tenants in part of this building. So the vendor has opted to tax that commercial property for VAT purposes. So in the absence of anything else, they would add on VAT to the sales price. So 300,000 plus VAT. Now, that's a bit of a cash flow issue because, yes, the pension fund could get VAT registered and claim it back, but is there a way to not have to pay over the VAT to begin with? Yes, there is. We invoke what's called the transfer of going concern rules. So when you acquire a commercial property and there are sitting tenants therein, which you will be taking over as the new landlord, the rules say that the vendor doesn't have to add VAT onto the sales price as long as you do certain things. One of them being that the pension fund must itself get registered for VAT and also opt to tax the building, which means that the future rents to the tenants will be subject to VAT, but presumably they already were to begin with by the vendor. But doing it that way means that the vendor can sell it for 300 grand without adding any VAT, and for SDLT, stamp duty land tax, the amount is less because SDLT, when you buy a commercial building, it is based on the amount plus VAT. So all of a sudden, from a cash flow point of view, you don't have to pay over the VAT and then claim it back 3 months later. Not only that, but you can pay lower SDLT because it's worked out on the amount without any VAT added on, which otherwise it would have been. So that's a tip there. When you're buying a commercial building and there are tenants therein, make sure you go for what we call transfer of going concern rules for VAT, which means the vendor doesn't have to add VAT onto the sales price. Save yourself a decent chunk on SDLT. And then, of course, also going forward, there will be rent. So now that there's this building, which the next generation have earmarked, they said, yeah, we're going to set up a new division or do whatever with the building, there will be rent from the company into the pension fund. And of course, that is tax deductible in the company and it's tax-free in the pension fund. So again, there's various options here. So that rent, they could just put it straight on the stock market, get it invested on the markets until such time as, say, for example, they find another commercial property in a few years down the line that they've found out they'd like to have that be part of the business. Well, at that point, you just liquidate the assets on the stock market. That's a tax-free event in the pension and use that cash to buy a second property. So you're getting double tax relief. You're getting rent and you're also getting pension contributions because there's nothing from stopping them doing another chunk into their pensions every year. Yes, eventually you're going to have the catch up with the carry forward, but it's still, as it stands, 60,000 a year each for these two in the younger generation. Now that's 120 grand a year on a regular basis. So over several years, that pension pot could be significant. So just an overview there on how you can utilize pensions for acquiring commercial properties for use in your business, and particularly in this angle involving next generation and the family business and having that pension earmarked specifically not for mum and dad but for the kids. So if you like this video, please do subscribe, and as always, I'll see you soon.